Hey, what's going on, guys? This is BloodFansome81. Welcome back to my channel. Today I'll be doing a video which is what is my ideal pie for beginner investors that have some time on their hands. So what I mean by that is if you guys are close to retirement, this might not be the ideal pie or investment allocation for you. I would probably invest a little bit more in bonds or dividend paying stocks. But if you guys are relatively young and have a lot of time to invest, this pie will be for you. So just a quick recap on my M1 Finance account, I have a couple of pies that I've made myself. The first of which is called High Savings. You guys have all seen that one. It's doing pretty well, I would say, but I won't be going over it today. I'll just say that I have a mix of all types of stocks, and it's pretty even, I would say. But the pie I'll be talking about today is this one called mutual funds. Now, a mutual fund is basically this, this kind of like a vehicle for investing. It's kind of like an ETF, but it's actively managed. So there is a money manager that will buy and sell based on different market conditions and based on economic data and things like that. So basically, someone is investing your money for you. But at the same time, you have a sense of what you're investing in, whether it's just small caps or mid caps or large caps. That money manager will trade according to the definition of that fund. Anyway, long story short, typically a mutual fund will contain lots of different stocks, sometimes 50, sometimes 100. It's usually around that range, actually. And one of the great things about mutual funds is that you can buy fractional shares, so you could just invest like $50 into this mutual fund, and that's totally fine. So pretty similar to M1 Finance. I would say there's pros and cons to both. I mean, I'd probably have M1 Finance than the mutual funds, even though I have both. But in this video, I wanted to talk about mutual funds and kind of like simulate one. So let me go ahead and hide myself really quickly. Float on top. Okay, so this mutual funds pie, it's basically 3 slices. So I'll be going over each of the slices, but first I'll do a quick overview. So the first slice is the biggest slice by far, and that's the growth pie. So basically, this is a that's my other video which is uploading. So this is a fast moving pie. This stock will probably make you the most money out of the other slices. Obviously, the reason being is because there's going to be a lot of growth stocks. But the reason why it's not 100% growth stocks is for the sake of not just diversification, but even when there's going to be periods of volatility, you want stocks that pay you dividends just for the sake of investing. So let's say the stock market, and this is a really realistic scenario, the stock market goes up a lot and all of a sudden it takes a really huge hit. Your portfolio might lose 15% in value, but if you take a look at some of the dividend players, they might not take that big of a hit, number one. But number two, they will continue to pay you dividends throughout this entire range so that you can get the best dollar cost averaging. So that's why it's good to have a mix of both. And not just that, but you also want to have stocks that pay frequently. So you don't want to buy only stocks that are going to pay once every 3 months. If you do pay quarterly dividend stocks, make sure you get, I want to say, a diverse bucket of those types, just for the sake of getting as many dividends as frequently as possible. So frequency is the name of the game, in my honest opinion, if we're talking about dollar cost averaging, which is something that I preach about a lot. So try to get different dividend stocks that pay at different times. So now let's jump into each of these stocks. So it's about 50 holdings, and most of them you guys will recognize. So in this growth stock, I have about 17 holdings. It's a mix between bank stocks and technology stocks. Maybe one industrial. So yeah. So the leading stock in this pie is Visa. And I'm a huge advocate of Visa. I'm probably always going to invest in Visa, to be honest, unless something really bad happens. But this is kind of one of those holdings that I feel good about. a little bit more than tech for some reason. I feel like Visa is not as volatile to the downside, or at least doesn't take that much of a hit if there's a bad earnings call. And I personally don't like seeing volatility despite me trading a lot of aggressive stocks. I'd rather not have something volatile, so Visa's kind of the way to go for me. But yeah, the next 3 stocks on the list are all really big tech stocks. So Apple, we all recognize Apple, the only $1 trillion company right now. And then you have Google and Amazon, some of the leading FANG stocks. And then next on the list, you'll have pretty much, I guess you can consider Berkshire Hathaway a bank stock or a financial stock, another finance stock, so on and so forth, and some other tech stocks. The other type of allocation I have here is pretty much market ETFs such as DIA and SPY. I really like DIA. In fact, someone on my video recommended DIA, and ever since I really liked it. So DIA will pay a monthly dividend of around 2.2%. So 2% divided by 12, and they pay out every single month, which is pretty nice. And so you kind of don't get that with something like SPY, which will pay quarterly. And SPY isn't a bad option. I mean, like, if you wanted to just invest in something that's pretty safe and will grow steadily, then SPY is the way to go. But I was interested in that monthly dividend aspect of DIA. So yeah, pretty much tech stocks and financial stocks. The next type of slice that I have is high dividend players. And so this is where I get a little bit more risky with the dividends. But the name of the game here, as I said, is frequent and high dividends. So pretty simple. I have about 10 holdings. The first of which is SPHD, which isn't actually that high of a dividend paying stock. It's only at about 3.71%. But it does pay monthly, number one, which is what I like. But number two, I love the trajectory of SPHD. So it has a very clear upward bias, and it's not very volatile. And the name in the stock is actually low volatility, because it's stocks with low volatility and high dividend players in the S&P 500. So I really like SPHD. And like I said, I also don't like volatility, so that's why I have this one as my largest allocation. And then the next few stocks are things like PCM. PCM I like because it pays on the first week of every month, which is kind of rare. GOF, GGM, or a couple of Guggenheim beneficial trusts, which I really like. SDIV I really like because it pays, obviously it pays monthly, as you can tell from the frequency of the dividends. It pays a really high percentage of 7.4%. And then not just that, but it invests in a lot of global stocks. So long term, that chart might not seem very inspiring, but honestly, it's not that volatile. Despite this range right here, I think the entire market or global markets had kind of a meltdown from this range right here. So that's one of the, I guess, downsides of investing in global stocks, is that international stock markets might see more volatility than the US stock market. But I feel more comfortable about holding something like this, which is extremely diverse, rather than just one type of company that's purely US owned. So that's why I have this one. The next 3 stocks are Gladstone stocks, which all pay a pretty high percentage. So Glad pays close to 9%, Good pays about 7.5%, and Gain pays around 6.72%. Gain in particular is probably the best out of the 3 if your goal is capital appreciation. But they're all really great. They all pay monthly, which I like. The next stock is SCM. SCM also pays monthly, and it's a really, really high percentage of 9.88%, which is awesome. And I like the capital appreciation on this one as well. And the last stock in this list is HCAP. So HCAP pays the highest dividend of 10.53%. Unfortunately, it's kind of choppy, which isn't that great. I'm currently up on HCAP just because I averaged down really low. But if your goal is capital appreciation, this one is probably not for you. So you can edit this pie as you wish. So that's 2 out of 3 slices of this portfolio. And then the last slice of the portfolio is the staple stocks. So this is getting as close to reliable as you can possibly get. in the stock market, if you're not counting bonds and things like that. So in this pie, I have lots of consumer staples and defensive stocks, which I have talked about several times on this channel. But most of these stocks will increase their dividends year after year, even during a recession. And so that's the difference between these stocks and the high dividend stocks, is that the high dividend stocks will most likely decrease their dividends during a recession. They probably won't decrease their dividends any other time besides a recession, but that's something to keep in mind if that's important to you. Because, as I said, during a recession, or basically any period of really severe volatility, you want to be able to average down. So let's say you lose your job or something, God forbid, during a recession, you can still be able to invest into your portfolio even if there's a recession, if you have these consumer staple stocks. So that's pretty much the pie. I'll make sure to share it in the description below. So if you guys are investing in this portfolio and you see that you might want to change something, then you can do that live on M1 Finance, which is pretty awesome. But yeah, so that's my ideal pie for young investors. I think there's a little bit of everything. Yeah, I'm curious to know what you guys think about this pie. Go ahead and let me know in the comment section. Is it a little bit too risky or maybe not risky enough? Let me know. But anyway, I hope you have a great day and good luck trading.